Let's break this chart down step by step and understand what the market is really doing. Starting from the left side, we see LS, Liquidity Sweep. Price runs above previous highs and takes buy-side liquidity. This move is not random. When liquidity above highs gets taken, it usually signals distribution, smart money closing buys and preparing for a shift. Right after the liquidity sweep, the market turns bearish. Price begins forming lower highs and lower lows, confirming downside momentum. Sellers are now in control. Once structure shifts bearish, our bias changes. We are no longer looking for buys, we are now looking for short opportunities. Price continues pushing lower, creating bearish expansion. So what is our plan? We wait for price to retrace into a premium zone to look for a high probability short entry. Now we identify our key area, the unmitigated point of interest order block in premium. Why this zone? Because this is the origin of the impulsive bearish move. It represents institutional selling activity. Since it remains unmitigated, there's a strong probability price will return to rebalance orders before continuing lower. But how do we know price will return there? From the lows, we observe something important. On the lower time frame, price forms a change of character to the upside. This is not a full trend reversal. It's simply a retracement structure, a move designed to bring price back into premium. As price pushes higher, we notice internal inducement. This is short-term liquidity created inside the structure. It traps early buyers and clears internal liquidity, strengthening the probability of continuation toward our higher timeframe zone. Then comes the next layer, major inducement. Major inducement forms external liquidity above more significant highs. This attracts breakout traders and emotional buyers. When that liquidity is engineered, it increases the probability that price will push slightly higher, directly into our premium order block. Now price taps into our marked zone. This is where patience matters. We do not enter blindly. We wait for confirmation inside the order block, such as a bearish lower time frame break of structure, strong rejection candle, or internal shift back to bearish. Now let's talk about targets. At the lowest point of the chart, we clearly see sell-side liquidity resting below equal lows. This is extremely important. Markets move from liquidity to liquidity. Since buy-side liquidity was already taken during the retracement, the next logical objective becomes sell-side liquidity below the lows. So our trade plan is clear and structured. Entry, after bearish confirmation inside the premium order block. Stop loss, place slightly above the order block with a small buffer to avoid wick manipulation. Logical placement, not emotional. Target, sell-side liquidity at the lows. This creates a clean risk-to-reward setup aligned with structure, liquidity, and institutional behavior. And remember, without proper risk management, even the best setup can fail. Risk only a small percentage per trade. Stay disciplined. Think long-term. Consistency is built on capital protection. Structure gives direction. Liquidity gives purpose. Order block gives location. Inducement gives confirmation. Risk management gives survival. Follow for more professional breakdowns and don't miss the next video.